for us, I mean, for Jamie and I, and it's something that is on our radar. We're taking as many steps kind of before that burn off you described as we possibly can. And I definitely think, if your viewers are not aware of it, they should be. And if they're not doing something about it and need to, they probably should.
What's been your strategy for, that? Because a stepped up basis does not solve that, right? It gives a stepped up basis for capital gains tax. But if someone's worth over $100 million and they only have a $12 million exemption, that other 88 million, if they're married, is subject to a 40% death tax. And so that's the Kevin Costner, if you've seen Yellowstone, I tell Kevin, you can solve it by, we use a DST plus to solve that, and no charity, no gifting, no life insurance required. But I'm just curious, what have been your ways, or what are your, how are you preparing for that?
Yeah, no, it's a great question, and it's a real challenge, because if you don't address it and tackle it, it kind of makes it puts your heirs behind the potential 8 ball, in that they may have to be forced sellers of an asset or a group of assets in order to pay the tax. And you see that actually a lot in farmland. Ironically, you have a lot of folks, it's generational asset, but they're forced to sell because of the tax on death, and it's pretty bad. So anyway, for us, I mean, for Jamie and I, and it's something that is on our radar. We're taking as many steps kind of before that burn off you described as we possibly can. And I definitely think, if your viewers are not aware of it, they should be. And if they're not doing something about it and need to, they probably should. I know we are. I know you probably are as well, and would tell your clients to do the same.
Yeah, I'll give you a couple ideas. And so most folks, and listen for listeners too, right? They have some methods, right? And there's definitely some methods. There's some gifting. There's the life insurance to offset it, right? Because life insurance is estate tax and basically tax free, but it only offsets. There's charity, give it away, which is great, and so, but beyond that, a lot of those things take a lot of time, or you have to have a lot of kids, or you run out of time. It's not very efficient, right? And so we have a solution called the Deferred Sales Trust Plus, known as the DST 2.0. Upon sale, just take a sale during your lifetime, you need to sell it. It moves from a owner to a lender, okay? In a particular way that we do it, it eliminates the estate tax outside your taxable estate, and your children can be the beneficiaries of the trust. Mm-hmm. And there's no longer estate tax. It's gone forever. It defers the capital gains tax, although there will be some capital gains tax paid over your lifetime. Yep. But it's a very efficient way. No charity, no life insurance, no gifting required. It also doesn't give up any of your lifetime exemption, gifting amount. Mm-hmm. And so if you have like a big $50 million, deal, you could do it in one day. Not only that, but it's important to understand that it has to take a sale. And so every single time we have a sale of something, if we're going to sell something, there's this window of tax planning, right, that you can capture. And if you don't, then you miss out on that window, right? So if you go too late on a 1031 exchange, or you don't set it up, you don't set up the deferred sales trust before closing. But this estate tax one is, I think, the most massive one, because there's $84 trillion set to transfer in the next 20 years. Those are the largest wealth transfers in the history of the planet. And to us, it's the battle for the wealth of American freedom, where the government not going to be very efficient with the capital versus the people to use it to build, mobile home parks, manufactured housing, multifamily. And so that's the concept, is that math piece and analyzing that. And so if people want to learn more about this, you can go to capitalgainstaxsolutions.com, where we in fact, we just helped a client, they're worth about 25-30 million, sell a $5 million multifamily property in Colorado, eliminate that $5 million of estate tax. And not only that, they're still mid-50s. All of the growth of that is outside the taxable estate. Yeah, and so you start thinking about that, the exponential, kind of like the infinite returns. Mm-hmm. It's no longer just about deferring 25 to 50% of capital gains tax. It's eliminating all of that outside your taxable estate and all of the growth. Any thoughts on that, Ryan?
I think that makes a lot of sense to me.